There are days when the economic data tells one story and lived experience tells another. The headlines report strong GDP growth. Stock indices hit new highs. Official statistics suggest prosperity. The economy expanded at 4.2% in the second quarter of 2024. The S&P 500 reached record levels. Tech companies posted unprecedented valuations. And yet, consumer sentiment surveys reveal widespread anxiety. Job security concerns are rising, and a growing number of Americans report feeling economically unstable despite the positive macroeconomic indicators. This disconnect isn't just anecdotal, it's measurable, and it's widening. Today, we're examining the gap between economic performance and economic experience.
The current economic expansion has a clear driver: artificial intelligence investment. In 2024, U.S. companies invested over $200 billion in AI infrastructure, data centers, specialized chips, and energy systems to power them. Tech giants like Microsoft, Google, and Amazon committed tens of billions each to AI development. The administration has embraced this trend. The president has publicly stated his support for AI expansion, calling it the future of American competitiveness. Economic advisors project AI could add $15 trillion to the global economy by 2030. The market has responded enthusiastically. The Magnificent Seven tech stocks, Apple, Microsoft, Google, Amazon, Meta, Nvidia, and Tesla, now account for nearly 30% of the S&P 500's total value. On paper, it looks like a boom, but the employment data tells a more complicated story. The hiring slowdown nobody's talking about. While companies aren't conducting mass layoffs, hiring has decelerated significantly. According to Bureau of Labor Statistics data, job openings in the tech sector fell 23% between late 2022 and mid-2024. Entry-level positions dropped even more sharply, down 35% in the same period. LinkedIn's workforce report shows that hiring rates for recent college graduates decreased by 18% year over year. The unemployment rate for workers aged 20 to 24 stands at 7.8%, nearly double the national average. Corporate earnings calls reveal the strategy. Companies are maintaining current headcount while investing heavily in automation and AI tools. They're not replacing workers yet, but they're not creating new positions either. Goldman Sachs estimates that AI could eventually replace 300 million full-time jobs globally. In the U.S., roughly 25% of current work tasks could be automated within the next decade. The message is clear: this growth isn't creating proportional employment opportunities.
The productivity paradox. Economists often point to historical precedent. Previous technological revolutions, mechanization, electrification, computerization, all caused temporary disruption before creating net job growth. The argument goes, AI will increase productivity, which will generate economic expansion, which will create new types of jobs we can't yet imagine. But the transition period matters, and this transition feels different. Unlike previous technological shifts that took decades to fully implement, AI capabilities are advancing rapidly. The gap between job displacement and job creation could be shorter and more abrupt. Workers don't have the same time frame to retrain. Educational systems can't pivot as quickly as the technology evolves, and the assumption that new jobs will emerge doesn't account for the human cost of the waiting period. Research from MIT suggests that while AI will likely create new job categories, these positions will require higher skill levels and more specialized training, creating a mismatch for displaced workers from routine cognitive tasks. There's another concern largely absent from optimistic forecasts: the financial structure supporting this AI expansion. Major tech companies have taken on significant debt to fund AI infrastructure. Microsoft's long-term debt increased by 45% between 2022 and 2024. Meta borrowed $15 billion in 2024 alone for AI-related capital expenditures. Energy requirements are substantial. Training a single large AI model can consume as much electricity as 10 American homes use in a year. Data centers now account for 4% of total U.S. electricity consumption, a figure projected to double by 2030. This creates a leverage risk. If AI applications don't generate the projected revenue growth, companies will face debt service pressures while maintaining expensive infrastructure. Some analysts see parallels to the dot-com bubble of the late 1990s: massive investment in transformative technology, soaring valuations, and assumptions that this time is different. History suggests caution: the psychological economy. What economic statistics often miss is the psychological dimension. A 2024 study by the American Psychological Association found that 67% of American workers report anxiety about AI's impact on their careers. Among workers under 35, that figure rises to 78%. This isn't irrational, it's responsive to observable trends. When job security feels uncertain, people adjust behavior, reducing spending, delaying major purchases, postponing life decisions. These individual choices, multiplied across millions of people, create economic headwinds that don't show up in quarterly GDP reports. The Federal Reserve's Survey of Consumer Finances reveals that despite strong aggregate economic growth, median household net worth adjusted for inflation has barely budged since 2019. Wealth gains have concentrated heavily in the top 10% of earners, those most likely to benefit from asset price appreciation. For the median worker, the strong economy remains largely abstract.
What are we measuring? The economy is growing. That's factually accurate. But growth alone doesn't capture well-being. It doesn't measure security, opportunity, or the subjective experience of economic life. GDP can rise while median wages stagnate. Markets can soar while job prospects narrow. Productivity can increase while worker stress intensifies. Perhaps the disconnect isn't between perception and reality. Perhaps we're measuring the wrong things. When economic success is defined solely by output, efficiency, and market value, human experience becomes secondary data. The question that remains: the current economic narrative is one of technological transformation and productivity gains. But transformation for whom? Productivity measured how? If economic growth doesn't translate into broadly shared prosperity, improved quality of life, or greater security for most people, then what exactly are we calling progress? That discomfort you might feel when reading positive economic news, that sense that something's off, may not be unfounded anxiety. It may be the recognition that the official story is incomplete. Next episode, we'll examine how economic value gets defined, who benefits from those definitions, and what happens to the people and work that fall outside conventional metrics. Because the problem may not be the economy itself, it may be how we've learned to see it.